This, I guess I'll share my screen here. This comes
Probably a
in
good
from
idea.
Ed. He is a client, and when I took the question from him, I wrote down he is also a fellow Oilers fan. So go Oilers.
Ugly.
I know Ryan loves hearing that. Um, so this is a company we've monitored for quite some time and interviewed management back in September 2024 in Vancouver. So we spoke with them not too long ago. Now, Enterprise Group Inc., ticker symbol E on the TSX, currently trading at a price of about $1.98 today. I believe it was actually down in the trading session, but that's just what I have here. I think it was down maybe about 10% or 8% today. The market cap is about 163 million. And they provide specialized equipment and services in the build out of infrastructure for the energy, pipeline, and infrastructure construction industries. They primarily have a presence across Western Canada with a concentration in Alberta and northeastern British Columbia. And their businesses include Hart Oilfield Rentals, which is a full service oilfield site service infrastructure company, including fuel, generator, light stand, sewage treatment, medic, security, and truck trailer combos. They also have Westar Oilfield Rentals, which is also a oilfield site service infrastructure company. They have their Arctic Therm, which provides flameless heaters. And then also Evolution Power Projects, which is their newest acquisition, which provides low emission nat gas powered systems and microgrid technology, allowing clients to eliminate diesel generators entirely. So the stock has had a strong year, up about 130%, driven by excellent financial results, which Aaron discussed back in May of 2024 when we covered the stock on the podcast last. And with both the fiscal year 2023 and Q1 2024 financial results driving the stock higher. And up on the screen here, these results here are what Aaron went over at that time. But as Aaron discussed back in May of 2024, when we covered the stock on the podcast, energy service companies can be very volatile, as shown by the company's long-term historical stock performance, where the stock took a drastic decline in 2014 and 2015 when we saw energy prices decline. Now, looking at the most recent financial results, which were for Q3 of 2024, ended September 30th of 2024, revenue was 6.8 million, a decrease of about 24% from the same quarter last year. And management noted that for the first 9 months of fiscal year 2024, they saw an increase in activity levels. However, Q3 saw a reduction in activity, with management attributing it to number one, apprehension and preparation for a potentially severe forest fire season, leading some customers to delay the execution of planned projects to the end of the forest fire season. And number two, some customers took advantage of summer months to allow employees extended time off to prepare for busy times ahead. And even though Q3 saw reduced activity, general activity levels are higher than in 2023, and management expects increased activity to continue throughout the remainder of 2024 and into 2025. Now, given the reduction in revenue, gross margin was down 37%, or down to 37%, from about a gross margin of 46% in Q3 of 2023. Adjusted EBITDA declined 47% to 1.8 million, and net income was a loss of 200,000 for the quarter, compared to a gain of 1.6 million for the same period last year. And just quickly looking at the balance sheet here, the company has about 8.1 million in cash. Debt and leases were 27.6 million, providing a net debt position of about 19.5 million, or a trailing net debt to EBITDA multiple of about 1.3 times, which I wouldn't say is bad or overly concerning. But as listeners know, we would certainly prefer the company to be in a net cash position, especially considering the cyclical nature of the business. But I also need to mention that the company did issue 15 million shares at a price of $1.90 per share in December of 2024, which provided the company gross proceeds of 28.8 million and should place the company back in a net cash position. And the company plans to use the funds for continued expansion plans as well as for general working capital. And this follows their previous financing of 8 million shares at a price of 85 cents for gross proceeds of 7 million in March of 2024. And I believe that after the most recent issuance in December here is getting the company up to an outstanding share balance of approximately 77 million shares outstanding. Now, quickly looking at the valuations, the company is trading with a trailing price to earnings multiple of about 15 times, price to cash flow of about 11 times, and an enterprise value to EBITDA multiple of about 12 times. And this compares to a trailing valuation of about 9 times earnings and 6 times EBITDA when Dunn covered them last in May. So the valuation multiples have been increasing, clearly, given the weaker Q3 earnings. So it's probably good to, see the company issuing shares at higher levels in the $1.90 range while, the valuations are, elevated a little bit more. But again, when we are looking at the valuation of a microcap oil and gas services company, we would expect to see lower valuations, like typically, below 10 times earnings or around 10 times earnings. But of course, this is all conditional on, the growth level and visibility of the growth. And growth has clearly, been very strong over the past 3 years. But again, we're dealing with a cyclical business. We would want to see, this cyclicality kind of shown in the valuation. So, I would say that at this point, the valuation is maybe more on the higher side when looking at the trailing results, given the recent weaker Q3, which management believes is somewhat one-off. But there could be some uncertainty looking forward, given the oil and gas tariffs, which could further delay some investment activities in the sector. Now, another piece of recent news that I would like to just quickly highlight is that Enterprise announced an exclusive agreement with Flex Energy Solutions, which is a global OEM manufacturer of microturbine power generation equipment, which places Evolution Power as the sole provider of short-term turbine and microturbine applications across all commercial and industrial sectors in Alberta and BC. So under the 5-year agreement, Evolution will exclusively provide its turbines and will help customers go from diesel generators to more efficient nat gas generators. And when we spoke with management in September, they told us that the flex turbine generators are much more effective or efficient in cold temperatures. So they believe that it is a significant advantage that they signed this deal. And as well, they also noted that they have about 15% market penetration of current sites that they could be in with their nat gas turbines. So they think that they have a good runway to grow this to, about 66% penetration over the next few years. So this is essentially, the runway of growth that they believe is ahead of them beyond, just the current typical demand from the Canadian oil and gas sector. So to conclude here, now, in 2018, Enterprise Group transitioned to move from diesel generators toward nat gas generators. Management considers themselves to be the leader of low emission electrification systems in Canada, and this was recently bolstered by their exclusive 5-year agreement with Flex Energy. And they noted that there is competition in the U.S. for these types of turbines, but not so much in the Canadian market. Now, the company has produced strong growth over the past 3 years with strong trajectory in revenue and margins. Gross margins have been increasing, due to less need for field techs. Management has stated, given a lot of switch to nat gas generators. Q3 2024 was weaker, which management expected, due to fires in the summer of 2024. And management believes activity in the space to remain high throughout the rest of fiscal year 2024 and into fiscal year 2025. The balance sheet is healthy and should be back into a net cash position following the December 2024 equity issuance. In September, management noted that they would like to get back into a net cash balance sheet to maintain growth. And really, I don't love seeing the dilution, as it will, evidently make it harder to grow per share earnings. But at least the company was issuing shares at higher valuations. Now, the trailing valuation multiples are not cheap, in my opinion, at about 15 times EPS and 12 times EBITDA. But again, this was due to the weaker Q3, which was expected. So the forward valuations may look better. But, I'd really like to keep a close eye on, the demand and activity in the sector, over the next few quarters here. Now, overall, I think it's an intriguing business with a runway of growth and attractive fundamentals driven by an upswing in the energy patch over the past few years. But my biggest concern is whether, that growth can continue in a space that has been historically cyclical, and whether companies, will be putting off investment decisions given tariff uncertainties, which could impact the business's recent acceleration in growth. Certainly a name that we will continue to monitor, though, very closely, and I'm sure that we will be speaking with management in the near future to get an update on the business. And here's a disclosure: we do not own the business.
Yeah, I think it's a good summary, and really, what you're just saying there is, with the uncertainty in the capex spending generally in Canada right now. I think you just wait on a company like that, see if you can get a more attractive entry point. I mean, that is on top of the fact that this company and anybody in the energy sector is cyclical in any market, and we have another layer of risk that's layered on top of us in terms of uncertainty in the near term. Just waiting. We're interviewing a number of these companies now. We think there's some value in these businesses long term. If we can get them at significantly lower prices, it may be something we look at. But when you're not trading at a depressed multiple and you have uncertainty, it's something that we'd be wary of in the near term.
Yeah.
And we'll track their quarters as they come out over the next 6 months to a year.